All right. Hey, everybody. Serge Berger here from the Steady Wealth Podcast. Very happy to have Brian Terry with me. For those of you guys that may not remember Brian, we've had him on the podcast before. If you are, of course, a Steady Trader client or a Blue Marlin client, you know Brian well. Maybe just Brian, quickly, if you want to just give us a couple of words of how we work together. You are obviously going to be a regular guest here on Forward. Maybe just a couple of words to remind people.
Sure. So Serge and I have been working together, I guess about 6-7 years now. We work with each other on the Steady Trader. We have a credit spread authority, CSA, an option service that we run. We also just launched a covered call service that's off to a roaring start. We're also partners in our fee-only advisory firm, a fiduciary advisory firm called Blue Marlin Advisors. So Serge and I have every time we talk about launching a new venture, which is always fun.
And to be fair, we have launched a couple of ventures together, right? As you just say.
For sure.
Well, listen, really what we wanted to do today is just take a little bit of time, and we're going to start sprinkling these in. We may actually at some point go up to like 2 podcasts a week. One of them kind of more big picture, then one of them maybe focusing a bit more on the markets, what's going on right now. But you know what I thought about, and for those people that are members or clients of ours, whether it's on the Blue Marlin side, as you say, Brian, that's our investment advisory firm where we do active advisory or, of course, manage people's money, or on the Steady Trader side where it's more alerts and research. You know that we tend not to want to be too directionally exposed to things. Every once in a while, you get caught. That's one of the things that happens. But just in general, it does feel, and I came across the AAI survey. I'm going to pull it up again in a second, which is the sort of advisors, how bullish or bearish investment advisors are. It's once again an extreme bullish. So the title of this podcast episode today is "Everyone is Bullish Again." What is your kind of overall take here? If you look across the screens and kind of talk to people?
Yeah, I mean, so 2023, especially if you look at stuff like the high flyers, probably 7 or 8 trades, companies. But if you look at the Qs, just as an example, NASDAQ, ETF, it's gone up like a rocket ship, and those kind of moves are hard to sustain in a good environment. Good economic environment. And, I don't think there's anyone out there that's going to say we're in a good economic environment. You got all kinds of problems. We could probably do a whole podcast on all the problems. But, so I would suspect, that the time that everybody becomes extremely bullish is probably the time we'll see a pullback. And, I was reading Barron's over the weekend, the newspaper, and they are just ripping bullish. They said the recession's over. Now's and it's almost like the perfect time for people to be grabbing profits and pull the market down. We just saw what Tesla and Netflix did after earnings. I would suspect we could see more of that. But it's hard to fight such a bullish trend, but you also don't want to be jumping in at the last minute and be the guy holding the bag when it does pull back.
Well, and that's the thing, I as much as we try to stay neutral, I did want to kind of put some asterisks around that. I think it's more about being realistic. And if there are two things that really pull the markets, it's one of them is liquidity. So how much liquidity is coming into the market? Maybe we should touch on that in a minute. But the other one, to your point, is really positioning. Mm-hmm. Coming into this year, fully guilty of that too, to be fully transparent. Everyone was too bearish because the playbook historically has always been that as the economy slows, the reaction function of the Fed is to ease. But I think what everyone got caught with that's had that experience for literally our lifetimes of investing is, I think everyone underestimated the amount of stimulus that was put in through COVID. It was just staggering, and it just takes more time. And I know in your neck of the woods, things are still buzzing, although apparently Disney World has low has the shortest lines in 10 years, which I'm excited
That's
about.
yeah. I actually have a short in Disney, so that's good news. But I think you're right. Everybody went in uber pessimistic, and the market just ripped higher, and then I think people just started jumping on the train, and like everybody knows, there's probably been about what it is, about 5 to 8 stocks that have really kind of pushed this market higher. If you look at like the equal weighted S&P 500, it's a pretty flat curve. But if
That's right.
you add in like the SPY, which is heavily weighted towards, the stocks that have done really well, that's a huge difference. And
Yeah.
so if those few stocks stumble, we could see, people saying, wait, I've made a lot of money so far this year. I'm getting out, which will cause a lot of selling pressure. But, the good news is, inflation seems to be seems to be working. It's becoming, went down from 9.1 to 3.0. That's great news. So people are optimistic. It's just that my take on it is we've gone so far so fast. Is it sustainable for the rest of the year? And my guess would be no, we'll see some kind of a pullback, and then we'll decide where we go from there.
I mean, I obviously you and I talk all day, so I can only concur. But I think that it brings up the very important point that we always battle with, and every investor has to battle with, which is what's the timing of that, and what's the time frame? Is that near term bearish for you? Also, necessarily, you're gonna have to play out for the rest of the year. And what does 24 look like, right? But maybe before we unpack some of this, Brian, I'm going to quickly share my screen, and then we'll leave this up. So and I always have to say this for those people that are listening right now on one of the podcast hubs like Apple or Spotify, I'm just literally showing a chart. You're not missing anything. I'm just going to describe it for you. But if you are watching this on YouTube, then obviously you will actually see this chart. So I do not feel like you're missing anything out if you are on one of the podcast platforms. And what this is here, Brian, is I'm showing what's called the AAII Investor Survey. This gets published, I think it's actually every week it gets published. And what I'm showing here is we can see that we've had the highest bullish posturing or bullish views of investment advisors, let's call it, for some time. And that usually tends to be kind of, as you kind of said before, Brian, sort of the tipping point where things get rockier,
Mm-hmm.
at the very least.
Yeah, yeah. I mean, exactly. That chart just kind of confirms, the shift to even more bullishness. I bet if you went back and looked at January, it would almost be completely red, and it's
Yeah,
just
yeah,
continued
exactly.
to become more bullish, which is good. But it also, you get, like you said, a tipping point. You get to a level where you say everybody is now bullish, and the market has gone so far so fast that uh, the market
That's right.
taking a breather, or just people that are saying like, hey, I made a lot of money on Nvidia this year, or I made a lot of money on Apple or Microsoft. I'm going to grab my profits, and that's selling pressure will pull the market down to some degree. And then, do buyers jump back in or not? Who knows? But the other thing that, we tend to forget, we've got a war in Ukraine, you got all the issues with China, all kinds of issues that I think people kind of forget when they become uber bullish.
Yeah.
And that's not a good thing. So, I think, our approach has always been, we want to be active investors. We want to be looking ahead for signs that, hey, this is changing so we can react. And that's a full-time job, right? I mean, we love doing it, but it's important. Otherwise, you just put your blinders on and just think the market's going to double by the end of the year. I think you might be in for a surprise.
Yeah, I mean, and that's the risk, right? In fact, just quickly going back to this AI survey, that again, for those people on YouTube, you can see this, you can see the screen again. You're not missing much if you are listening to this through traditional podcast channels. But just to kind of put this into perspective, if you look at it at the bottom of this, Brian, in the week ending 9/21/2022, so that's the 21st of September of last year, more or less the market bottomed a few weeks later. The bearishness was 61%. So 61% of those surveyed were bearish.
Yeah.
Right now, 51% are bullish, which is actually quite a bit above the average. So at the average time, investors are about 37% bullish. 37% of those surveyed tend to be bullish. Right now at 51, 52. That's quite extreme. I've seen more as extreme, but it is worth pointing out that we're certainly at a point where this is getting quite high. In fact, if I look back here in time,
there you go.
it doesn't. I don't have the entire.
That's good enough.
But it goes back far enough to understand.
Hey, Serge, the other thing I was going to just add,
sure.
Barron's has a thing they call the Delta Market Sentiment Index, which is where they go out and ask money managers, are you bullish, bearish, neutral? They are 71.6% bullish. So that just tells you these are the guys kind of managing the money. They're plowing money. They're still bullish. No sign of abatement there.
Absolutely. And I do want to talk about here next. I do want to talk about the how people tend to, as you say, they tend to get caught flat-footed. Everyone's chasing these moves, and there is, by the way, a lot of rationale for why these chasing moves. I always talk about it, and I know I tend to sometimes get almost a little bit bitter about it because it's just not rational. But human beings are not very rational. We are just not meant to be rational beings, I guess. But if you think about it from a fund manager's perspective, sometimes it's better to chase than to dramatically underperform the market for a near-term window. But what tends to happen, and this is what I always push back at when I hear people trying to chase, my argument is always, listen, you can chase what we don't know. And people always say, oh, I can time getting out. There's a really bad track record of people trying to get back out because you don't know. You can get lucky, by all means, one can get lucky timing it out, but it doesn't usually feel like it's a time to sell when the elevator goes back down, because it's, as we know, it's escalator up, elevator down. Same thing, by the way, on the way down, right? At some point on the way down, like even last October, it was an escalator down, no longer an elevator, but then it started becoming almost an elevator back up recently here at the peak. So at the peak of a rally, right, you have elevator up in the end because everyone's chasing, but at that point, that last elevator move, like those last 5-10 floors get erased in equally a short amount of time. And that's really what I'm always concerned about, because if you think about this from a trading perspective, yes, it's a thrill to take part in that last breakout, but you will lose that so quickly that it wasn't really worth doing it in the first place. But it's hard, the whole human emotions get between us, right?
Yeah. I always look at charts and I say, these are pictures of emotions. When the market is ripping higher, that's greed, right? People are saying like, I don't want to miss out on this. When the market is selling off, that's fear, so you get to those levels, right? You get to that top level and it starts coming down, then fear kind of creeps in or jumps, consumes people. I had a client the other day that said, hey, the market was down, 2%. At this rate, in 20 days, it'll be a zero. I'm like, okay, that's one way of looking at it. But, it's just, people get irrational when emotions take over. And that's one thing we try to do is look at it from the facts and the trends and what sectors are doing well, and not try to say, like, oh my God, we gotta buy more Nvidia, it's gone up again, kind of thing. Yeah. And that will keep us from getting our face ripped off. I think you say that a lot. We don't want to get our face ripped off when the market does reverse lower or something happens.
Yeah. No, that's exactly what we see. And it's the short-termism. And again, this is not to make fun of people. I mean, we're all human. It's really human emotions that are exposed here. And it almost comes down to a philosophical question. I ask myself this all the time when I talk to clients. Is fear a more powerful emotion, or is greed a more powerful emotion? And now it depends. What I would argue in life in general, greed is not a bad thing. In fact, this goes back to the Gordon Gekko quote. I don't know if you remember in Wall Street, he said, greed is good, but people say, oh, that's a, financial greedy, financial bastard. He was very clear, greed for life, greed for knowledge. Like, that's not bad.
No, that's great.
It's the greed in the market. So that's why I want to be very specific. Greed and fear. We're talking about the markets here.
Yeah.
I would argue greed is worse sometimes in the markets than the fear. Now, the fear, you can really miss out on things, but greed can really, really, really kill you.
Yeah, I mean, I think what greed is people that are investing, overweighting in sectors or in individual stocks that have too much risk for their risk tolerance or their current financial situation. That's kind of comes back to burn you more than just being a cautious investor.
Yeah. I certainly want to also sneak in some actionable thoughts here in terms of the second half of the year here, Brian, in just a minute. But to me, if I were to kind of, I don't want to summarize it because we're not done yet, but I just kind of maybe recap a little bit what we just said. There is always a misalignment of time frames. And like right now, and we're fully transparent. We actually have a drawdown in one of our accounts, one of our portfolios at Blue Marlin. It's normal, folks. That happens, right?
Mm-hmm.
And what we see is lots of clients are getting, or some clients are getting nervous about this, rightfully so. But their near-term linear thinking, like you said, that whoever you were talking to that said at 2% down a day, you're at zero and not today, right? They can't look beyond the next trading day or the next headline.
Yeah.
And this is really not even, it's just human beings. Like, that's how we react. But rationally, if you look at it a little bit further, it's the misalignment of timeframes that causes these fears.
Right.
And, things are really almost never linear in life, and certainly not in the markets. When I talk to people, and I know you do too, I just yesterday spoke to another gentleman, a new client, and he was talking about he wants to make X amount of money every single month. And I had to explain to him that that's an admirable goal, but very unrealistic to make money every single month, right? Linearity, I think the linear thinking really gets people in trouble. It's very much like chasing at the top or chasing at the bottom.
Yeah. I would say one thing too, Serge, is that, when with our clients at Blue Marlin, what we really try to do is be in touch with people, right? And make sure that if they have concerns or issues or just things are changing in their personal situation, we're always willing to talk to them. And we're willing to, and we are completely transparent in what we're doing and what we recommend. And being a fiduciary, we have to, we're required by law, but I always say that makes perfect sense. We always want to do what's best for the client. And so, I just think that, we're willing to, share everything we know and see with the clients, or and I think that helps them ease a lot of that fear. They may say like, hey, I'm thinking this or this, and we can kind of walk through it. And then probably I would say over half the times they say, yeah, you're right. That wasn't a good, thought process, or that's a great thought process. And now they have confirmation and can move forward.
I mean, that personal touch that you're talking about, the talking points. But so when I talk, just like you, when we talk to clients, I should use the we here, obviously. When we talk to clients, the conversations we're having are so powerful to get people to either maybe walk back from the ledge, or maybe, come off the ceiling a little bit, or just have a conversation about whatever their investment or trade is that they're thinking about. So the benefit here of having an investment advisor, I think, has become a bit lost here since the pandemic, because everyone's into newsletters. And of course, we all our research as a study here, it's all newsletter based and all that stuff. But where things really make a difference, and I think that's what you're saying, is when you have the ability to have all that research, but then have a conversation with someone about what you're thinking from that research. So like this is literally how professional investors work. So like us, right? Like we read research, we subscribe to research on the institutional side, and then what do we do internally? We discuss it internally.
Mm-hmm.
The retail investor, however, a lot of times they will read a newsletter like our Steady Trader stuff, right? Great. But then they're left on their own to make a decision in terms of sizing and everything else. So
Yep.
having that partner to discuss this with, I think, is one of the most underrated things for people that are nowadays are just focusing on these newsletters. So that's really, really important. These conversations are, I mean, just, even just you and I, and of course the rest of the team, just having these conversations is I will every single time, and it's multiple times a week, we have conversations about the markets and allocations. I come away feeling better.
Yeah, the other thing that we can do or we do for our clients is keep in line of their long-term goals too, because you could have a bad week in the stock market and people say, "Oh, this is terrible" and all that. But if you look at the big picture, what are your goals? What were your objectives? Long-term goals. You're right on track, or you're still blowing through those goals. So it's easy to forget about it, but it's important not to.
Yeah, exactly. I know we want to wrap up here in just a second, and as we're recording this, the stock market's about to just open. So just so you know, so if you hear the bells going off, just really quickly, Brian, let's give people an actionable thought here. Do you think the technology rally is going to continue at the rate it has the first half and the second half of the year? And if no, maybe we can give them an alternative.
Yeah, so I do not think it will continue. I just think it's an unsustainable rally for the first 6 months of the year. So whether it will, reverse, I think it will do more of like an ABC kind of pattern where it will pull back at some level. There'll be a lot of people grabbing profits, getting out, but then at a certain level, I could see it, ramping up again. Like we always kid about if a stock mentions AI, their stock price goes up. So, but I do think we'll continue to see sector rotation, probably out of technology into some of the other sectors that haven't participated, and so my guess is, without doing a ton of research for the question, is I would not be surprised to see some kind of a correction, at least a minor pullback, and then maybe a rotation into more sectors that haven't quite have participated as much in the first half of the year.
Exactly. So, I mean, maybe just to be very clear, one of the parts of the market that we are thinking about is energy in the second half of the year here. And we are already in the second half of the year, to be clear, here in July. But that rotation, and this does not mean that we're looking for a giant bear market in tech, right? It's right. To be very clear, because you didn't say that, right? You said just some sort of rotation. Now also to be clear, for a stock like NVIDIA to correct 20-30% after a move like it's had is really not that big a deal. So maybe just keep that in mind as well. It's all relative to what we've done. I know we got to run. Thank you, Brian. Great pleasure. Thank you, everyone, for listening out on podcast land or on YouTube. And we'll see you back here with the next Steady Wealth podcast. Be well, and we'll see you soon.
Thanks, everybody.